Indian stocks started Monday on the back foot, but investors expect the government's latest reforms to turn the table on recent losses seen in the markets, including the record low rupee. Bets are for stock benchmarks to extend their gains from late last week to fresh record highs. And the changes from 100% FDI in the insurance sector to widening the pool for pension funds to invest in has boosted sentiment. Now, on Friday, India's Union Cabinet, it approved a bill to increase foreign investment in insurance from 74% earlier to 100%. That is aimed at expanding coverage and bringing in more players into the sector. The approval is expected to increase competition and provide better protection to policyholders. Potential benefits also include enhanced customer service, quicker claim settlements, and higher quality products. The move will bring in more global capital for a growing sector and offer multiple choices for Indian consumers. Now, the reforms are part of the government's Insurance for All by 2047 initiative. On Wednesday, the country widened the assets pool that the National Pension Fund can invest in. Under the new rules, funds can now be invested in stocks beyond the earlier limit of the top 200 companies. India relaxed credit criteria for some debt securities. The sponsor rating requirement for real estate investment trusts and infrastructure investment trusts was scrapped. Gold and silver rallied after the regulator, for the first time, allowed pension fund investments in those metals, exchange-traded funds, ETFs. Separately, in a significant shift in India-China ties, the country has quietly opened the door for Chinese business experts again. Officials say applications that were earlier stuck for months are now being cleared within 4 weeks. The shift follows Prime Minister Modi's visit to China earlier this year, his first in 7 years, where he met President Xi Jinping and discussed ways to steady ties. The visa free up is expected to help electronics, solar and telecom companies that have struggled with a shortage of specialized Chinese technicians. At a regular briefing in Beijing, a Chinese Foreign Ministry spokesperson made its most direct comment, calling India's move a step that serves common interests.
We have taken note of this positive action, which promotes the facilitation of people-to-people exchanges and is in line with the common interests of all parties. China is willing to maintain communication and consultation with India and to continuously improve the level of facilitation for exchanges between the two countries.
Investors bet the government's reforms will also flip the currency's recent slide. The rupee crashed to a record low for the second straight session on Friday and is defying India's growth story. Now, the biggest risk for the currency has been the delayed trade deal and 50% US tariffs on Indian exports. But trade talks between the US and India have gained fresh momentum in recent months. Official negotiations they've followed by a phone call between Prime Minister Modi and President Trump, that they reinforce that optimism. While a trade deal looks elusive at the moment, foreign inflows are expected to increase on the latest reforms and boost the rupee. All right, joining me live now is Ajay Bagga from Mumbai. He is the Executive Chairman of OPC Asset Solutions Limited and one of the most respected experts of the Indian financial industry. Mr. Bagga, thanks so much for making time for us as always. Now, the government says 100% foreign investment in insurance, it will expand coverage and improve services for the average policyholder. But what should change first? Pricing, claim settlement speed or product quality?
I think claim settlement speed. We have a very low penetration of insurance. I was shocked to read the data that even in automobile insurance, we are 54% insured. So nearly 1 in 2 vehicles are running uninsured in the country. And a big issue there is the claim settlement, which takes a long time, especially on health and life. We have seen a lot of rejections. In health insurance, there was data out that some of the multinational companies reject over 80% claims, and they really string out customers in terms of paying their claims. So claim settlement better, then products, and then bringing in a lot of digitization and first world practices to deepen the insurance. I think that would be the preferred route.
Understood. And, Mr. Bagga, when we speak of the pension funds and being allowed to be invested anywhere beyond the top 200 stocks, what kind of an impact do you foresee or expect on portfolio returns and diversification for ordinary retirees?
Yeah, it gives more flexibility to the fund managers to move from they were limited to the top 200 funds. So if you look at 200 shares, now it's gone to 250, top 250 stocks. So more diversification, more opportunities to look at lower capitalization stocks, which are normally higher growth and higher yield stocks. The second thing is the silver and gold ETFs being allowed. So those have really outperformed this year, are expected to perform well over the next 3 years as well. So giving the flexibility to pension funds to invest in gold and silver is also a welcome move.
Understood. And now when it comes to the impact on the rupee, with visa clearances easing for Chinese tech experts and expectations of higher foreign inflows as well, can these reforms realistically stabilize the rupee?
Not the Chinese visa reform. See, China got a free lunch from the West when it came into the WTO in 2000. And they know the lessons that how the Western economies were hollowed out by China becoming the factory of the world. If you look at Chinese manufacturing, it's about $4.2 trillion. Our manufacturing is about $780 billion. So we are a fifth of the Chinese manufacturing economy. They are not in a rush to build a competitor like India. We have seen with the companies like Foxconn, where they recalled Chinese engineers, Chinese specialists at the peak of the season, just before launches by major phone brands. So they will do their best to ensure China plus one does not emerge via India, but rather through their own controlled economies in the ASEAN region. So I'm not expecting much FDI from this China visa move, but any de-escalation is welcome. I don't expect too much FDI, but overall the rupee, we have to unleash the next set of reforms to attract more FDI. That is the only way. So there you are spot on. More government action, more reforms are needed, and more opening up, like we have opened up the insurance sector. I remember in the late 90s, whenever we would pitch insurance companies to majors from abroad, they would ask, how much is your FDI limit? That time we were at about 26, and they would say, not interested in creating wealth for someone else. Come back when we are 100%. I think this 100% reform is a very big thing. It can attract a lot of capital, and a lot of global insurance majors might enter the Indian market. So like that, we have to open up our domestic industry to competition and really unleash a set of reforms to get in FDI.
That was Ajay Bagga joining us from Mumbai. Many thanks, sir, for joining us and making time. Would like to discuss things further as things evolve.
Thank you.